Welcome back. Muni bonds are typically considered a safe haven, but not so much lately. Been under some pressure, and UBS is blaming that weakness on some higher supply and in part due to the tax and spending bill. Here to discuss is Parametric's Nisha Patel. It's good to have you, Nisha.
Yeah, good to be here.
This is getting a lot of attention, and there are questions about, as we pull back on Medicaid, for instance, what does that mean for finances? What are all the factors that have led to this kind of bout of selling in munis?
Yeah, so I would say there are two main takeaways that were included in the bill that's really had an impact. So first, in terms of supply, if you look at the budget bill and what was encompassed in there, there was a higher threat of the tax exemption being eliminated from munis, and certainly a lot of talk around that headline risk. And at the time, a lot of pay-fors were on the table, right, to kind of close the gap, to come up with revenue-raising measures. And so as that threat just kind of came about, if you're a municipal bond issuer, you're looking to issue a certain amount of debt in the market, a lot of that was pulled forward, right? Why wait for any possible changes, any possible volatility in the market?
Oh, interesting.
And so you have seen issuers just saying, look, let me come out to the market now. And so we do think a lot of that issuance was pulled forward. And also, this is on top of what is already, I would say, a year that was going to be higher issuance anyways. You have a lot of new projects being worked on due to inflation costs. Projects are costing more. So you couple that all together, and we've just seen a tremendous amount of supply, which is really what has caused the underperformance in munis.
Is it coming from any one particular part of the market or geography, or is it kind of across the board? And I have to imagine, look, if what you're saying is just a supply-demand imbalance, could be a great opportunity. When I hear people around here anecdotally saying, have you seen what you can get in New York? 10%, 11% tax.
So what I'm here to talk about, Kelly.
Yeah.
Yes. I mean, that's been the silver lining. So my answer to you is, like, it's been across the board. And so if you think about where a lot of these deals are structured and think about where the demand has been kind of centralized for muni bonds, two main themes here for, I think, fixed income investors in general. There's been a lot of fear of taking on a lot of duration, which makes sense, right? Just given what rates have done. Clients want to stay kind of 10 years in. So if you have a lot of these deals that have longer maturities, you don't have any natural buyers in that part of the curve. So what you've seen is that higher supply has really put a lot more pressure in the longer end of the curve to where the muni curve is tremendously steep. So when we talk about opportunity now, your long end munis are up 80 to 90 basis points in yield. So now you're looking at tax equivalent yields for New Jersey, New York investors in the long end, anywhere from 8.5% to 9.5%, depending on the credit quality and range, which is just absolutely incredible.
I mean, is that sure money? Is there, because at some point you go, okay, there must be some risk that budgetary. I mean, I know it's been a long, long time since there's been any real concerns.
Yes.
But just curious.
It's a good question. It's a good question. And I think it all depends on how you take exposure, what type of credit quality, right? Like in any market, there's going to be a vast amount of different credit quality in issuers. The main takeaway from the budget bill was, I would say, high level for munis, was the reduction in Medicaid funding for states. Now, every single state, generally, for the most part, they all have to balance their budget. So, if it all is going to be on a state-by-state basis. So if a lot of states or certain states are relying on Medicaid a lot more than others, they're going to have to come up with other revenue-raising measures, cut costs. So my point being is, it's on an issuer-by-issuer basis. But Medicaid cuts alone are not going to be detrimental for states, right? You're still looking at a very high-quality market where post kind of COVID, even as pandemic stimulus money has run out, the economy's been great, right? And that's meant more revenue, right, for states in general. And so you're seeing very solid financials for states. So for high quality bonds, when you're achieving this type of yield, that's a tremendous opportunity. And I think, at Parametric and as professional managers, we're here to do that professional credit work too, right? Keeping you out of certain sectors and really extracting the most amount of value.